For decades, there was this one guy on Wall Street, Bernie Madoff. People thought he was a financial magician, a total genius. But it turns out, behind the curtain was a lie. A lie so big, it almost broke the entire system. So today, we're going to pull that curtain all the way back. We're going to look at how he built the biggest financial fraud in modern history.
Okay, let's just start with a number, because honestly, it's hard to even wrap your head around. $64.8 billion. That's the amount of fake money that was on the books when this whole thing collapsed in 2008. It's just a staggering figure.
But look, the number is only part of it. The real shocker was the guy behind it all. Bernie Madoff wasn't some nobody operating from a basement. No way. This guy was Wall Street royalty. He was the former chairman of the NASDAQ, a legit pioneer. He was the establishment. And that's what made it so effective. He used that trust, that reputation, to build a house of cards that stood for decades. So his whole sales pitch was simple. I'll give you steady, safe returns. And for year after year, that's exactly what people saw on their account statements. The only problem? It was all fake. A total illusion. So that leads to the big question, right? How did a scam this huge operate right out in the open for so long? How did it fool everyone, regulators, huge banks, even the smartest investors on the planet? Well, that's the puzzle we're going to piece together right now.
All right, so the $65 billion question, how on earth did he pull it off? To get it, you have to understand the machine he built. And what's wild is that this machine had two totally separate parts. Okay, this is where the genius of the whole scam really starts. It was physically separated. Get this. In this famous building in New York, floors 18 and 19 were his legitimate business, a real pioneering, totally respected company. It was the perfect cover story. But then, one floor below, on the 17th floor, that was the fraud factory. Secretive, restricted access, run by a handful of people he trusted completely. And their whole job was just to fake everything.
So what was actually going on down there on that secret floor? For all the complexity, it boiled down to a dead simple classic Ponzi scheme. Step 1, you get new investors to give you money. It all goes into one big bank account. Step 2, when old investors want their money back, you just pay them using the new investors' cash. Step 3, you print up fake account statements that show everyone making nice, steady profits and mail them out. And step 4, you just do that over and over and over again for decades. No stocks were ever bought. No investments were ever made. It was just a giant circle of money. But you can't run a simple scam like that without a really, really good cover story. And Madoff's, well, his was a masterpiece. He came up with this super technical, super secret investment strategy that nobody could figure out, but everybody desperately wanted to believe was real. He called it the split strike conversion. I mean, it just sounds smart, right? He'd tell people, oh, I buy a bunch of safe blue chip stocks, and then I use these complex options to put a collar around them. The idea was it would limit any losses, but still make money. And what was the result? Those famously steady 10 to 12% returns year in, year out. It was the perfect explanation for his magic. Except, of course, for one tiny detail. He wasn't doing any of it. It was all a lie.
And this is where, if you look at the numbers, the whole thing just falls apart. See, the returns themselves weren't the crazy part. The magic trick was the risk, or, well, the lack of it. His reported volatility, that's the up and down swings, was just 2.45%. That's impossible. The actual stock market is like 6 times more volatile than that. Even if you tried to do his fake strategy, it would still be 4 times more volatile. And look at this. Over 92% of his months were positive. That just doesn't happen. The real world has down months. It's a dead giveaway.
Okay, and this chart, this is the mathematical smoking gun. It's called the Sharpe ratio, which is basically a score for how much return you get for the amount of risk you take. Higher is better. So the market, the S&P 500, is down there at 0.36. The fake strategy he claimed to be using would get you maybe a 0.66. Madoff's reported number, 2.47. It was almost 8 times better than the market. It wasn't just good, it was literally impossible. His returns looked like a perfect 45-degree line going up. In the real world of finance, that line does not exist. So, okay, the numbers were fake. The strategy was a total lie. So how did nobody catch this? Not the regulators, not the auditors, not these giant funds pouring billions in. Well, turns out someone did catch it, and he spent the next 10 years screaming about it to anyone who would listen.
And that someone was this guy, Harry Markopolos. He was a math whiz, a financial analyst. And way back in 1999, his boss told him, hey, figure out how Madoff is getting these returns. We want to do it too. Markopolos later said it took him about 5 minutes to realize it was a fraud, and then another 4 hours to do the math to prove it. This quote you see here, that's from a memo he sent directly to the SEC in 2005, basically spelling it all out.
And look at this timeline. It's just staggering. Markopolos sent his first warning to the SEC, the main financial regulator, all the way back in 2000. Then again in 2001. Then he sent that huge, detailed memo in 2005. He tried again in 2007. For almost a decade, this guy was yelling at the top of his lungs that the biggest fraud in history was happening right under their noses, and nobody listened. It's just incredible.
And the stuff he was pointing out wasn't all super complex math either. Some of it was just common sense, laughably obvious stuff. Like, he calculated that for Madoff to be making the trades he claimed he was making, he would have had to buy more options than existed on the entire planet. Or how about the fact that this $65 billion fund was being audited by a tiny 3-person accounting firm in a strip mall? It's nuts. He didn't even charge normal fees, which made 0 sense. These weren't subtle clues. They were giant flashing red flags, and they were all ignored. So that really begs the question, right? With all these warnings, so many obvious red flags, how did the system fail so badly? How was this guy just completely ignored? Well, this next part is a story about a total breakdown at the one agency that was supposed to prevent this. You're not going to believe this. The SEC, the top financial cop on the beat, they investigated Madoff at least 6 times starting in 1992. 6. And every single time, they walked away saying, nope, everything looks good here. They were just completely snowed by his reputation. They believed the man instead of checking the evidence. It was a complete and total failure. I mean, the agency's own internal report later on basically called their investigations incompetent. In 92, all they had to do was make one phone call to a place called the DTC. That call would have proven Madoff owned 0 stocks for his clients. One call. They never made it. Fast forward to 2006, they asked Madoff who he was trading with. He just handed them a fake list. The SEC investigators actually wrote up letters to check with those firms, and then they just never mailed them. It wasn't about cracking a complex code. It was about doing the absolute basics, and they just didn't. So, if the watchdogs couldn't bring him down, what did? What finally made the whole house of cards collapse? Well, it's the one thing that kills every Ponzi scheme eventually. He ran out of other people's money. The machine needed a constant supply of new cash to keep going. And in 2008, the music stopped. Remember the 2008 financial crisis? Yeah, that was the catalyst. The whole world was panicking, markets were crashing, and Madoff's investors, well, they wanted their money back. And they wanted it now. About $7 billion in withdrawal requests came pouring in. But there was nothing to sell. There were no stocks, no bonds. There was just that one bank account, and the money was gone. The whole thing was over. And this is why the damage was so widespread, why it wasn't just a few rich people in Manhattan. Madoff was smart. He used what are called feeder funds. These were other investment firms that would go out, raise billions of dollars from people all around the world, and then just funnel it all straight to Madoff. The feeder funds got paid huge fees, so they had no incentive to ask any tough questions. And that's how a fraud born in New York ended up ruining lives all over the globe. Now, in the years since, there's been this massive, unbelievable effort to claw back some of the money. And the trustee in charge has actually managed to recover almost $15 billion, which is pretty historic. But you have to remember, that's still just a fraction of the fake money that people thought they had. And it can never really undo the damage done to so many people and so many charities that were just wiped out. And what did Madoff himself have to say about it all? His explanation was chillingly simple. He said, everybody was greedy, I just went along with it. He basically blamed everyone's desire to believe in an easy thing. The investors wanted the impossible returns, the funds wanted the fees, maybe even the regulators didn't want to rock the boat. Everybody was so in love with the story that no one dared to ask if it was actually true. So when you boil it all down, the Madoff scandal wasn't really about some criminal mastermind. It was about a failure of basic verification. Trust, but verify. Well, everyone just did the trusting part. They trusted the reputation, the name, the story, and nobody checked the facts. And that leaves us with a really important question for right now. In today's world of finance, which is even more complex, are we any better at this? Or are we all still just one really good story, one charismatic person away from the next $65 billion lie?